All right, so what we're doing is looking at multiple time frame analysis, and we want to make sure that everybody's all logged in. All right, and you guys can hear me. I see the microphone's working. So it's going to be a quick class and how I like to do things. So for instance, you have these different charts up, all right? And what I like doing is 1 minute, 5 minute, I'll put a 15-minute up here. I put a 1 hour. I also put a 2 hour. You can use a 4 hour, whatever floats your boat. All right. You can put a daily chart up also. And it's all about doing 2 time frames at once. All right. Where is support, where is resistance, and also using 2 time frames. So let's just take something simple as this 15-minute chart. All right, and let me just change this to, let me just save this template. All right, so let's put on that chart, and let's show this chart. So one is a 5-minute chart, and the other is a 15-minute chart. So you have 2 time frames that you're looking at. So let's take a look at this higher time frame, and what does it say to us? Well, it says we have a swing low, we have a range low, right? We have this whole data in here, this whole area in here to watch, all right? So you got bulk of your information is right in this area. Okay, right there. All right, right here. So we see the range lows all in this zone here, okay? And this is an area to get serious about. Well, this is a higher time frame, so you're always looking at higher and lower time frames. If I want to buy this particular zone, I want to start looking at the lower time frame for a pattern to form. Okay, so we look at this whole move down, and what we like doing is we like using also indicators. Okay, all right, so we've got the indicator here. So what the indicator is telling us is this is a lower low on price, and this is a higher low on the oscillator, which is creating what is called a divergence. So that means there's a loss of momentum going to the downside, but where would you buy? Why would you buy? Okay, see, that's the pattern to buy, but let's look at the higher time frame. All right, what's the higher time frame telling us is there's tons of support down here. All right, tons and tons of support down in this area based on this prior action. So we know if we get down here, we're not just going to buy. The momentum is going down on this time frame, but since we're in a trading range, it's also oversold. We're looking for a divergence, a pattern on a smaller time frame, so you can use a smaller time frame entry into a higher time frame support or resistance. In this case, this is support. So here on the left, you have the divergence pattern, which created that buy area versus the higher time frame support, that's where you start looking at the multiple time frames. You're using 2 time frames at one time to determine support, resistance, trade entry, and risk. So let's just say you were to trade this particular pattern. First off, your initial risk has to come down here. Okay, has to go below. All right, has to go below all this, which means that your risk here would have been right there. Okay, so you're looking to, this comes down, you start looking for support, maybe it comes up and starts coming down, you're looking for a buy opportunity. That's a divergence pattern. It's already telling you the momentum stopped going down and now shifted, and this is where you would take a trade, enter, and you get a play back to the upside. Now, normally it's the moving average is where you target on a divergence, but the entry is because your higher time frame is in support. You follow? So give me a moment. Okay, in terms of doing your charts, Trish, you basically just keep opening up different charts, and I can show you how to do that. That's not a big deal. All right, we'll do that tomorrow. If you remind me, I'll do that with you tomorrow, okay? So what we have here is that's your risk and your reward. So let's take a look at what had happened today. All right, remove. All right, so today, for the signal service, we caught a little trade, right? And we discussed in the, let me just move this higher here. There we go. We discussed in the room what we were looking at. So we're going to review that also and go over that. So again, multiple time frame analysis. Our thoughts today were, if the market moves up into a zone, we're going to look at this as a key resistance area. So what we did was we took this swing down for a test back up. All right, and how that worked was, let me just open this up. Let me get this actually on a 5-minute chart. Okay, that's better. So again, once again, we're going to look at multiple time frame analysis, and we're looking at the fact that the daily chart is at these all-time highs up here. It's right at a big key area resistance. We're also looking at the prior day's high and low, and we're looking at prior swing highs and lows right here. All right. So now what we did was we put in Fibonacci retracement. So we looked at, I'm not sure if this was a bad tick or not, but I know this for a fact that that was the proper area right here. So if we look at this in terms of an extension, all right, we felt in the opening play video that if we can go up to the 1272 to the 1618 extension, that if we get up there, that's going to be an area to watch. Although there is no resistance above in terms of price, we do have Fibonacci extensions, and we know that by doing our chart work, we have swing high, swing low, and we have the zone to watch. All right, it can go this high or it can come this high, right? It can go here. It can come down and go to the 141, or it can come down and go up to the 162. So this is what we had looked at this morning or last night in our opening play video, and that set the stage for key resistance. So if we just look at this area and we maybe color it a little bit different, all right, tomato. It's tomato colored. So how did this play out? The market rallied into the zone, so I'm going to remove these little triangles. All right, this triangle. Actually, this triangle I'm going to remove. All right, if we look here, it pushed into this zone. All right, it pushed up into this 1272 to 1272, 1618 extension. Then you have the 141 extension. So it pushed up into that zone, and that's the first thing we have to respect. All right. Turn around. We open this. We got his. We got that. So the market backed off, right? And then tried up again. And what did it do? It put a lower high and then came down a little bit. So once it stopped going up, this is telling us that that higher time frame is giving us some resistance. All right, so let me fix this down this way. Okay. And then we got the 1 minute chart. Let's bring that 1 minute chart down. All right, hold on. Let me just organize this. This is what I was looking at earlier. So you guys know. This is what I was looking at earlier. Global crosshair. So much for global, right? It's useless. Okay. So we shorted at 1675. And depending on your fills, you got about 1550, I would say, which pretty accurate to say that that was the trade. You have to remember the market's been real quiet today. Didn't want to get into trouble. All right. So what did we have here? We had the higher time frame. This hit the higher time frame. All right. You see that? Hit the higher time frame resistance. And now it started coming back below that 113. And to me, that's a big deal. It came back below this 1272. It failed at the 41, came down, and was right around this area, right here. So it's telling me that it failed up here on the 141 extension. It failed at the 1272, and it's starting to fail here at the 113. For it to come back up would be a major event. It really would. All right, so you're looking at little loss of momentum, you can call it. That's fine. I was looking at this in pure price action, and what I was starting to see. What I was starting to see was, here is your high. Oops. Your high. Your lower high. Lower high. Second data point. And I'm going to explain what that is. All right. And the reason I'm putting this up there is so you guys can stop the video and look at it over. Okay, support and resistance. A lot of people don't get the term support and resistance. They think because the market went here that that's resistance. And when in fact, the market technically needs 2 data points to establish a resistance or a support. You need 2 data points, not 1. All right, so a lot of people in the trading arena who don't understand true technical analysis consider 1 spike as resistance. It's really 2. So when you're seeing the second data point fail, that's allowing you to use this area as a risk. So you want to be as close to the prior retest as possible. And once that failed, so the market came down, went up again, made a lower high, came down, started going sideways. So to me, this said we could short and we could put our stop right up here. Not a problem. Okay. That told me that I could go in and take a 2-point risk if I chose to and look for a first flush down. Now, some people will say, well, you got to have a certain ratio. You have to have a 3-to-1 or 2-to-1 ratio. If you're going to risk $1, you got to make $3 or whatever. That's not necessarily the case because you need to allow for the market noise. If you're established a resistance here and you're failing, this is telling you that this is resistance. It should not go back above that and should continue lower. The path of least resistance is down. This is the resistance. That's not the path of least resistance. That's telling you that we're not going back up there. It made a lower high and then started consolidating. So the play was take a short, and when it tests down, okay, let me show you. When it tests down, take it right into this prior consolidation, this prior information here. We're in a consolidation type environment, all right? We're in a consolidation type environment. So all this data I was looking at on this higher time frame as key resistance. It's telling me I've made the 1272, 141 extension up. I found a little double top on a short-term time frame. It's also here. Put another lower high. I'm able to short with enough comfortability that I'm not going to come back up here. So even if it wiggles around, I could always get out or minimize my loss. And in this environment, I just wanted to take a quick flush. We took 6 ticks out, 5 ticks out, whatever, and you walk away. The point is you're using 2 time frames, multiple time frame analysis, okay, multiple time frame analysis to enter a trade. Okay, I'm going to put the video on pause for a moment. Okay, so let me make sure everybody's still, okay, we're all good. So as you see here, you're using multiple time frame analysis for a trade. Let's take another trade that I'm looking at right now. It's an hourly chart. All right. It's an hourly chart. It's the GBPAUD. GBPAUD. I think. All right. So I'm looking at this chart of the hourly GBPAUD and that we have resistance up here. So first things first, and I'll draw out what we're looking at. And I believe, no, I haven't sent it out to the service yet. All right, we're taking all these little swing highs. You see all those little swing highs? That's where your key resistance is going to be at, right there, just like that, okay? That's where your resistance is at. This whole area is resistance. Now we take a couple of other things and that we add to it. We start looking at the Fibonacci levels. Now you could take it from here, you could take it from here. Now if you take it from here, this is your swing. If you take it from here, this is your swing. This is your reaction up, down, up. So I'm asked a lot of times, well, where do you know where to pull it from? This is a whole interruption here, so I would not have any use for this. This would have been useful on this down, up for a projection to the downside, all right? But like for instance, I'm just going to show you. You have a swing high and a swing down, a swing low, swing high. If I was using this, I would have taken like this, all right? Because I know I get these questions all the time on how do you know where to pull it from. All right, so you throw an extension in there, then you start looking at where things line up. In this case, we're looking at this whole swing down. This is a leg that formed, all right? This is a leg that formed that went down, all right? This is a leg, let me just find this arrow. This is a leg that went up and then tested down again, and now is trying up one more time. So if I look at this in regard to a pattern, we see what is starting to form up here. It looks like a big shark pattern. So if I draw in, conceptually, I draw in the triangle. All right. And then I start looking at the pattern from high to low, from low to high, from high to low, and we stop right there. Okay, we can take this pattern and I throw some extensions on that. All right, I'll throw some extensions right in here. And I see what lines up. You got the 162, you got the 200, and I get rid of all the other noise, okay? All right, I get rid of all this other noise. Then we look at this pattern here. Same thing on the downside. We look at an extension to the downside, and we see that price did come in between the 113 and the 161 extension. And then we have this swing here. All right, so the pattern risk for the shark all right, let's just get rid of, actually, let me just do like that. This will be easier. One, 1, 3, make that, put some dots here, and then we'll do the risk on it, and we'll look at this as, say, a 141. All right. All right, so your entry zone, what happens when you have the shark here, 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 and then this is actually right to here. That's the proper shark pattern. All right, and then we're going to bring that risk down a little bit. 130. Let me just fix this risk. Let me see. 130. All right, so we go right above the 1272 extension. So right here is where your risk would be. All right. If you look at this in this format here, it should not get back above this high. So you can put your risk in here, or you can put your risk here. So regardless, it doesn't matter at this point. We know that the market is in a key resistance zone. Okay. We know right now it's in a key resistance zone. We're going to color it in, and then we're going to start looking at something else. Okay. So let's go here and get the same GBP/AUD. So that's the higher time frame. We've established the higher time frame resistance area. All right, you all with me? We established that higher time frame resistance area. Now we want to start looking at the shorter term time frame. So this is the same chart, if you think about it, same chart. And we're looking at a couple things. Number one, you have your divergence pattern right here. So this is telling you that potentially you're losing momentum to the upside. right? I don't know what that is. Okay. You lose a momentum to the upside on this, right? So this would be generally a short zone. So you look at lower time frame. You look at a 15-minute chart, all right? You're looking to see they have a loss of momentum up here. This is all little loss of momentum, although they're still pushing up. I would like to see prices lose this area. So a couple things can be done in this area. If you want to take a risk in this zone versus your stop up here, small risk, there's nothing wrong with that, okay? You can just do that. Or a more conservative person will say, you know what, I want to see it stop going up. I want to see this uh, change and shift momentum and go down, all right? Not that you're going to miss all this area because it's a big part, it's a big pattern. And then a reaction back up, and then you have all this resistance now to play with. What this does is prevent you from shorting into strength in an uptrending market. See, if you were to short up here now, it can still go higher, and you really have no resistance until up here. So you're working with the pattern, the divergence. The second person, who's a more conservative person, would say, I want to be short. I want to see it move down. Then when it moves up, I have all this resistance to work against. So even if it comes up into this zone, all right, let's just say that's a real trade. You're sitting there, you start doing this. You start putting your Fibonacci in there. You start putting your levels, your zones, and that you know all this up here is key resistance. And where does your risk go? Your risk would then go right above, okay? So you're waiting for it to lose momentum, waiting for it to shift, get a flush, and then that reaction up, you're putting your stop above the high. What are we doing here? You're using two time frames. The higher time frame says it's a sell. The lower time frame says it's still going higher. So if it's still going higher, you have a risk of shorting into strength, or you could be patient. I don't see a problem with putting a little position here and a little position higher. There's nothing wrong with that. All right. I personally on this one, because the first zone here was on the shark, the second zone was here. I want to see it come back below the maximum shark zone, meaning that's the name of the pattern. It looks like a shark, right? It's biting you or something. I don't know. So I want to see it come back into the zone, the proper zone that should be shorted, which is this. Okay. I want to see this. I want to see it back in this trading zone. Once it comes back in, I can start identifying this risk point, and this will be the zone. This is what they call a PRZ, price reversal zone, or a pattern reversal zone, however you want to call it. I would have no problem waiting for prices to come back in here and then giving us an entry. That entry being on the smaller time frame when they flush down and they change the momentum, they stop going up and then they shift it, then you could work with an identifiable risk point as opposed to shorting up here and saying, okay, let me go to sleep tonight and hopefully I wake up tomorrow, it's lower. So that's something that you can work at. The other thing is, if you want to do a risk point, you say, okay, here's where my entry zone is. Here's my risk point. I could risk, it's 390. I could risk 50, 40 pips. Let me see, I don't know, 30, 35 pips. All right, I have no problem with that. You want to risk 35 pips? Maybe put one position per $1,000 on a mini. So you're breaking it down. You're doing 1%. So 1% per thousand, you're risking $3.50. All right, that's okay. All right, doesn't seem like a lot. It's not a big deal. You're risking not a lot, but if you break down, all right, you can come down 100 pips. All right, you got yourself $10 per thousand locked in. So if you say, okay, I could risk $10 per thousand on the trade. All right, so knowing that it's 20, 35 pips, you do 3 percent, you do 3 micros and per $1,000. And then if it comes down, you've made $30 on the trade. So you well, actually a little bit more, but that's how I would look at this in that regard. You're risking on your risk to reward. But forget about all that, the number gibberish. The point is you have a zone, resistance, you have a shorter term time frame, and you're waiting for the short term time frame to set up a pattern, and there's no identifiable pattern. Once it shifts back below, I think it's 1.837 is the 113 area right up in here. Once it shifts back below that, that's telling you it's done. So let's go back here. So that's how you use a multiple time frame. You're looking at the bigger time frame resistance or support, and now you're working with the short-term time frame. You could drop it down to a 5-minute. So somebody says to you, well, you shouldn't trade a 5-minute on Forex, you know? I get that. But you're not trading the 5-minute, you're trading the hourly chart entering on the 5-minute. So if, for instance, okay, this shifts down like that, then you get your move back up. You have all this stuff in here, all this price data. This is all going to be valuable to you to protect you against a risk point. Your risk point's up here. All right, and this is going to protect you. I understand you have the spread. Okay, you add for the spread. The point is you have all this data right here to protect you against any reaction up. So if it flushes, you can get back up. The other choice was, if you're taking a bigger picture view, you don't need to worry. You just put your position on, you have your stop, and if it turns down, you're good, okay? So that's what I'm looking at. I'm looking at this bigger time frame as a sell, the shorter time frame starting to lose momentum. You want the bigger time frame to come back a little bit lower below that pattern and start getting that wave to the downside. So in terms of an Elliott wave, if you're looking at this saying, okay, I want to look at this, that if it shifts, how do we treat it in the Elliott wave format? Well, you always have your 0, your 1, your 2, your 3, or that would be an A to B, C to D relationship. A to B, C to D relationship. You're working with the trend impulse, not against it. You're working with the impulse, and that any reaction up should be limited for a whole flush. Now, we don't know at this point what's going to happen because we're doing this live and we're saying, okay, if it comes and does this and it does that and it does this. We don't know what's going to happen, but that's what you look in terms of road mapping, that if it does flush down, all this data is important, all right, and this reaction up, you would have protection. Now, if it stops here and starts flying up, obviously it's null and void, and that's all it is, all right? You don't stress out about it. You just wait for the pattern to set up again. So you're looking at the higher time frame, you're looking at the lower time frame. The higher time frame is dominant. That's telling you that your trend turn is going to occur, but you don't do anything until the shorter term trend triggers you into it. Therefore, you have the wind at your back that if this sets up a sell and this sets up a sell, you got your odds working for you. It's when that the higher time frame is setting up a sell and this is still pouncing to the upside, and you try to short into it because the big time frame, and you're missing the whole picture. The whole thing is you identify a zone, you identify a turning point. When that turns, you then start looking at the shorter term time frame, and now you have a lower risk entry versus a higher time frame pattern. And with that, we went for about 35 minutes. It was a quick class, and I hope it made sense to you. And thank you very much for listening. Rock and roll.